This is my investment strategy for Finance 695 for Project 1. My strategy actually consists of a negative return on equity. If you have a negative return on equity for that year, you would eliminate it. Also, taking into effect rising PE values, which is price to earnings ratio, and then also the market to book ratio. Market to book ratio will show you the market value for each dollar invested, and the price to earnings ratio will help to distinguish high growth companies. The reason that I chose this strategy is because I wouldn't invest in anything that had a negative ROE, uh, especially because that would show some problems with a company as far as negative earnings. And then also the market to book ratio should potentially offset any overvaluing of a price to earnings ratio. So how this works, the strategy works, is you would weigh the PE ratio with the market to book ratio by 50% each, and then eliminate those years that have negative return on equity because you wouldn't invest for those periods. And then you'll compare it to the stock prices for each of those years. What I did is I actually took 5 companies that are in my industry and I compared them for each year just to see if there was any correlation by using a regression. When I used the regression in my industry, there was an actual correlation with this strategy with the pricing of stock. The 5 companies that I used included CB&I, Fluor, Jacobs Engineering, URS, and Tetra Tech. The T-stats for all of these exceeded 1.65. As you see here, the regressions test that was taken for the company that best represented the company I work for, which is URS, shows the p-value that's lower than the 0.01 that was required to show significance. However, when I actually tried this um, test on for this strategy with other companies, the other 14 companies that I analyzed, only 5 of them actually showed a significance between this strategy and the stock prices. The 5 companies that actually showed significance included Caterpillar, Community Health, Intuit, Monster, and AT&T. The other 9 companies actually showed no significance. So what was the reason for the discrepancy? Well, in my industry, which is environmental remediation, it's not highly cyclical, and that is important because the PE ratio that's used. Also, it is a capital intensive industry, and that is important because we are using the market to book ratio as a factor. Also, any companies that may be going through a transition or restructuring may show a negative ROE, and using this strategy would actually not work and to show a correlation for companies that are in this situation. Other factors that I would want to consider would include the DuPont analysis for ROE. The DuPont analysis can actually be broken apart and show operating margin, financial leverage, and asset management. Other considerations would include the growth rate, and with a growth rate, it would give you a better idea of the future value, and also the economic value added. Economic value added is a good indication for economic profit that's generated from a capital investment or from capital investments. Financial analysis will also require multiple factors that include industries that you want to invest in, what your risk preference is, high risk, low risk, medium risk, and how long an investor would want to keep that investment. So if you're looking into just a short-term, gain, or if you're just looking to invest for maybe retirement, you may want to look into some companies that are more catered to the length of time that you want to invest. Thank you so much.